Welcome to the weekly update, where I'll go over the action in the market for the week of November 17th through the 21st, and we'll see how things look for the week of November 24th through the 28th. And in the upcoming week, it will be the Thanksgiving holiday on Thursday. The markets will be closed. The markets will be open on Friday, but they will close at 1 p.m. Eastern Time, which is, if you're on the West Coast, that's 10 a.m. I love those days. You might have to get up early, but hey, you're done working by 10 o'clock in the morning. But the past week, we are still looking more defensive. Now, a lot of the cause of this is a little bit of fallout from, of course, from the government shutdown, and then where is everything going to land as far as economic reports? We still don't really know that. And we had some released this week, and I'm still very confused. And as I said in other videos, I use two different sources for the calendar, and they're different from each other. So I don't really know when things are coming out. I don't know if anybody really does. They're just kind of making this up day by day as we go along. That's one of the unsettling things because the market doesn't really have anything to key off there. The big thing goes all the way back to the previous Fed meeting when Jerome Powell said, well, we're not so sure about that rate cut. Now, we've been having a really good run in 2025, and we could still finish strong in 2025. And we're in a period of positive seasonality that should have started already, but here we are coming up towards the latter part of November now, and this seasonality just has not appeared, at least yet. And we're seeing a little bit of weakness coming into even our longer term charts here. Now, we at some point this could all finish. We could finally get to some kind of a bottom and then come up out of that and then finish things strong. That is one possibility. Now, if you remember that back in 2018 there was a mini crash that happened on Christmas Eve, and that's, the end of the year, and that didn't turn out so well. It worked its way out after that. But even this past week, we had a pretty significant down day on Thursday. Now, Friday was options expiration for the monthly cycle. There's options that expire every day, but then the big one is the third Friday of every month. That's kind of its own crazy day, and we actually ended up going up almost 1% with the S&P, but really didn't improve with anything. We're still seeing the growth to value ratios weaker. We're still seeing some of the AI concerns because a lot of people are saying, oh, there's an AI bubble, too much money's being spent. Once they spend all this money, it's all going to be finished. Well, if you know history very much, they said the same thing about trains, and they said the same thing about the car, and they said the same thing about the radio and the TV and the computer, and all these things were like just little fads that were going to come and go, and they didn't, because it was shifting how we think about things, and it ended up changing productivity. I mean, I'm an educator and I teach using a computer now. When I first started teaching, computers just were almost being born, at least on the personal computer level. You had Apple had some of their early machines out there, and you had some of the IBM type machines that were available, but it was very new. And now they said the same thing about the internet too. Oh, it's a fad. It's just going to go away. Well, now it's become a way of life and people do things in a different way. Just think back to what, 2006, 2007, whenever the iPhone came out. I remember first hearing about that and laughing. It's like, why does Apple want to take an iPod, which was very popular, and turn it into a phone? You kind of chuckle about those things. You think that's kind of silly, but look at how that's changed everything. Now everybody has a smartphone and they've got their noses in their phones. I mean, back in the 70s, I never took my phone to the dinner table because it was this big honking thing that you didn't dare barely move. You didn't see a need for it. But anyway, it's part of the natural process that goes on with AI. And if it ultimately bleeds over and grows over into productivity, then it's going to change things and it's going to be new. And there's going to be companies that come up with ideas that go by the wayside, like Beta, VHS, and different forms of technology, laser discs. and computers that have tried to come in and take over and do things that kind of fell by the wayside. That's part of the overall process. And we're seeing that work its way out in the AI trade. And there will be companies that don't exist anymore. So picking the right companies can be a bit challenging. But we just have to kind of grow with this and see that we're getting a bit of a paradigm shift as we go into AI. But the market's going through some growing pains right now, and plus just some good profits. I mean, even if we ended right now, it would be a really solid up year. We could even fall further than what we've already gone down and still have a very good year. So, yeah, people think the way things are right now are the way they're always going to be, and the market goes through positive times, which it had a really negative time last spring, and now is a bit of a negative time now that we don't know if it's over yet. After some really positive times early in 2025, and then since we came up out of the lows in April of 2025, the market's just been on fire. Why did that happen? Because a lot of people didn't think it was going to happen. Why is the market going down now? Because a lot of people thought it was going to go up. Market's really kind of cruel that way. It doesn't always do what we think it's going to do. We can't control it like we can like at your job. Like I'm a teacher. I can get stricter. I can have rules so people don't talk. I can control that kind of an environment. In your job, maybe you're a supervisor or maybe you are responsible for things. You can rearrange how that actually works. You can control that. You can't control the stock market. And that's why a lot of people really struggle with having consistent success in the stock market because they're used to having control in their lives and in their jobs and in their families. And then they jump into the stock market that's completely out of their control. And it's like, and they use the same basic thought processes in the stock market that we use in real life. And it just doesn't work that way. And that's why my approach is different. I figured this out decades ago and have taken a different approach with analyzing the market. Look at as much information as you can, get as big a picture view as you can, and then drill down to what's actually happening right now. Okay, so also in my program, I do have courses and I do teach things. It's called the SPX Investing Program. It's still free from now until the end of 2025. Feel free to check it out. You get immediate access to this video, which is delayed on YouTube and Rumble, and all the videos. You get access to that. There's additional videos and additional information that I post there. Now, when you sign up for the full-blown site, you do have to provide payment information. That's a Substack thing. That's where it's hosted. And but you're not charged anything. I go in and I immediately comp you, so nothing's going to be charged to your payment, probably debit card that you might use. Now that's going to change at the beginning of 2026, but I'll give you lots of warnings about that. But check it out. It's free. Just see if it's something that you find useful. Okay, so let's go back and talk about the week. We were down 1.95%. Now, we would have been down close to 3% had we not bounced up a bit on Friday. We did have an up day for the indexes, but we didn't see much improvement in when we look under the surface with what's actually happening. We were above average with volume. We've been above average most days. And then, of course, Friday was options expiration, where we see a lot of volume on those days anyway. Now the technicals, we're seeing some weakness. We're giving some back here, even on the weekly charts. They've been holding up a little bit better, seeing a little bit more weakness now, but in the bigger picture, we're still looking positive. And I'll show you that as I go through the charts. Interest rates really haven't been that big of a deal now. We're above 4% with the 10-year yield, but we actually dropped down a little bit. And we're not seeing a real flight to safety at this time, going out from the stock market into the bond market. We're not really seeing that. Inflation doesn't seem to be a real problem right now. Earnings, well, now, if you had asked the market before Thursday, how are earnings going, you would say great. And then at the end of Thursday, you would have said terrible because NVIDIA, that was the big event they reported after the close on Wednesday. And they were up over 5%, and the futures were up about 1.5% with the S&P. And we had a good solid open. And what we've seen before is we saw some selling, we hit overhead resistance, and then started to go down. And it ended up being a pretty negative day. that way. But we've been seeing this building over a period of time, and we're still seeing it to a degree. We're not really seeing a lot of proof yet that the market's switching back to a more of a pro-growth offensive type of posture yet. It's still looking more defensive. Now, that could start to shift at any time. And this stuff just doesn't happen overnight. We just watch this over a period of time. We did get some Fed speak that earlier in the week was more hawkish, later in the week was more dovish, and the market's really not concerned about going into a recession right now. Now, this is a change. For a long time now, we've been positive with the ADX because the green line's been above the red line. But this week, the red line's crossing above the green line. This is where we're seeing a little bit more weakness developing in the longer term on the weekly charts. And we're negative on the daily side, both in the short and intermediate term. Now, we don't have a trend here. We're still below 20. We don't have a trend on the daily side either. But it's starting to shift over and look a little bit more negative. And I'll show you that chart. Okay, and I made a mistake. It's negative. The green line should be below the red line, not above. Okay, so for the week, the Dow was down 1.9%. Just a little over a week ago, it set an all-time high over 48,000, but it's been getting hit lately too. NASDAQ down 2.7%. That's where we're seeing a lot of the growth is getting hit these days. The S&P down 1.9%. And actually, now a lot of this came in Friday's session because the small caps and even the mid caps were not having a good week. And then so there was some Fed speak that came out and said, well, I might be open to a rate cut in December. And that was enough. This is not Chair Powell saying this. This is just one of the committee members. But it was different than what we had been hearing up to this. And that was enough to push the S&P up and bounce a bit with the indexes, and it really helped out the small caps and mid caps. And it's not off the table yet. I'll show you the charts later on. The big shift that we saw there. And the Fed could cut rates in December. It might be considered a Christmas gift or something if that happens. So the stock market, we did have a lower week. We were down roughly 2%. Okay, not quite, about 1.9 something here. With the S&P, the NASDAQ down 2.7, the Dow down 1.9, retreating beneath. Now, this was a technical thing that happened. The major indexes, the Dow, not so much the Dow, but the S&P, NASDAQ, and NASDAQ 100, plus some other indexes that we follow, they're pretty much all under their 50-day moving averages now. And that changed on the daily side. We were already negative in the short term because we were below the 20-period moving averages. And when I say that plural, I mean simple and exponential. Now we switched over to looking more negative in the intermediate term because we're below the 50-day moving averages. And it was pretty choppy throughout the week. Small caps, now a lot of this just came on Friday. So they were down 0.8% with the Russell 2000. That's the other small cap index. I follow the S&P 600 because it lines up with the PE ratio comparisons there. Mid caps were down 0.7. They got a lot of that back on Friday. So they were down a little bit less in that regard. Mega cap is lagging right now. And because of continued caution among investors around the largest names like Nvidia, Google seems to be holding up quite well. But some of the other big names are getting hit right now. And Nvidia faced its own selling pressure, delivering, it had just a stellar report. And they even had good forecasts going forward. And then we reversed on Thursday. It was a classic pump and dump that we were seeing in Thursday's action. And now the stock, it went from being up over 5% to being down about 3.5% on Thursday. That's a 8.5% swing. That's big. So, but for the week, Nvidia still ended up being down 2.8%. Tech and discretionary are also lagging. We want tech to do well. That's growth. We want discretionary to do well. That's growth also. And Tesla has been getting hard. Amazon has been getting hit a bit too. And healthcare, defensive, communication. Now that is a growth area. Then that's been holding up a bit better. And then staples, lead. That's another defensive area. So we're seeing a continuation of this defensive rotation. Then this is what happened on Friday. John Williams, who's the New York Fed president, said, well, I might be open to a rate cut in December. And the market liked that and didn't get a huge bounce out of it, but it did turn a really flat day into a somewhat positive day. And then the market remains in a risk-off posture. And every day in the daily videos, I have a risk on, risk off chart. And in the bigger picture, that's still going up. But in the shorter term, that ratio is going down with mega cap and tech leadership still fragile here. And then, so overall, the week reflected a market balancing between optimism because of a potential rate cut and caution over, and they always blame valuations. We're still very overvalued. And watch the intermarket analysis video. I go through that more that I do right after this video. And the momentum has also switched over to more negative. But the bigger picture is still looking okay. While rate cut chatter offered intermittent relief, broader weakness in tech and mega caps weighed on the major averages, leaving the market in a state of ongoing rotation and selective strength. Just there are some stocks that are doing really well, like Google has been holding up pretty well, but you didn't want to own Nvidia on Thursday. You wanted to sell it. So, all right. And then I show this every week, just showing we're still down in this lower area as far as inflation. We're a little bit below 3, but still above 2 with the percent for inflation. But we haven't had the core PCE report in a long time now. Just to remember that there things can and do change, and we might go into some kind of a high inflationary environment. But we're not really seeing any concerns either by the market or by what information we have been getting. All right, so and we're coming closer down to this 4.02%, so that's helping earnings a little bit better. When we're above that, that tends to bite into corporate earnings. Now, this was actually updated. Now, and there's still some charts that are not going to be updated, but the number of unemployed for going on the seventh month here, that's picking up a little bit. And that's longer term unemployed. What we were seeing before the government shutdown is a general theme where the initial unemployment was not all that bad, but those folks that were getting laid off were staying unemployed for longer, with the continuing claims starting to go up. And then this going up, that means they're unemployed for even longer than that. So just want to keep an eye on this overall. And then those that are employed, usually working full time, just kind of leveling out here right now. Didn't see a real big change there. Then FactSet had a couple of posts. It says S&P 500 companies, they're reporting the highest net profit margin in over 15 years. I actually went over this particular chart in the daily video. They made it available at Isabel Net blog charts. But this is what we're seeing going up, and this justifies prices going higher because profits, that feeds into the whole earnings and sales and all of that. And when these are going up and to the right, that is more positive, even if it's more on a forecast right now. Then reporting highest revenue growth in 3 years. Okay, so more money's coming in. Here with this chart, we're going up over here, and we're also going up here. Also projecting it out, not really strong, but still looking fairly strong going forward. For some reason, in the third quarter of 2026, they have things slowing down a little bit. Okay, then here is the chart going on Monday. And we've been negative. We were negative a week ago, and we started to initiate some bearish positions, and it had a lot of them come through. We started to trend. So I was doing more market neutral strategies. Those are all done now and did really well with a lot of them. Some we had to get out break even because we were starting to fall too much and starting to trend. And then we switched over and started doing bearish strategies, and those have worked out quite well. So we ended up just kind of flat here. And then we broke to the downside on Monday. We actually gapped a little bit lower and went down, but then we're able to bounce up off of that going into Tuesday. And then we started off pretty positive on Wednesday, but then came down and closed just not, didn't really move all that much. Then here's Thursday. Nvidia, it was kind of a quiet day on Wednesday because everybody was anticipating Nvidia. And so what happened is the report was great. The futures spiked up. Nvidia stock was trading much higher in after hours, and we held on to those gains as we went into the open on Thursday. And then we topped out just at the 20 period moving average, the simple moving average on the daily chart. And that was also the high that we set last Friday. And so we hit some resistance. Things started to fizzle out. And then we had the pump going up and then the dump as we were really going down. The buy the dippers tried to come in a couple of times, but we ended up pretty much closing at the low for the session. And then this is Friday where we were pretty choppy. And then those Fed comments came out and I kind of bumped this up here, tried to come back a little bit, got back above the daily pivot, went in here and actually went a little bit above 66.50, but then did see some late day selling going into the close. And we didn't really see much improvement under the surface on Friday. All right, so for the week, the NY, excuse the small caps, they ended up being up on the week, but all of that was pretty much Friday. Okay. And then you had the NASDAQ 100 growth, NASDAQ growth, the S&P growth and value ended up being down. These are just the 5 trading days. Now we have small caps year to date. They're back down to break even. So if you bought the S&P 600 small cap ETF last January, whatever the first trading day was, the second or third or whenever we started, and you're holding on to it, you haven't made or lost money to this point. And here we are coming up to the end of the year. But we still have the NASDAQ 100, NASDAQ, they're leading the way higher. And the S&P, I mean, even if we quit now, we're still up 12.26%. That's not shabby. It's not the 20% returns that we were seeing before. But again, still pretty respectable here with the NYSE and then the Dow also up. All right. And then the different sectors. So ended up having a down week. Tech is getting hit, seeing some rotation there, seeing some profit taking going on. So this ended up being down over 5%. Now, energy, which is more defensive, it also got hit, and discretionary got hit. The industrials and the financial sector continues to show some weakness. We've been watching that for months now. Utilities were down, and materials. Where healthcare, this has been the strongest area as of late. And that's a defensive area, but it's also an area that's just been getting hammered for the last, well, especially in 2025. And the earnings are still looking pretty good. So now you've got more money going in there. Staples, another defensive area, ended up being up slightly. And then communication, which is a growth area, was up slightly on the week. Now, looking at the scooter score, look at this 96 for healthcare. Haven't seen that one. It was down into single digits not very long ago. It was like at 8 or something. And we still have tech looking okay, but it's coming down a bit. Energy, communication, utilities, they're still more on the positive side. And then we see some weakness here with discretionary. That had been coming on over the summer, and then we hit the fall, and boom, it started to not do so well. Real estate still is not doing all that well, as are materials. And even though Staples had a pretty good week, they're not looking very good here when we rank them on their scooter score. All right, so this is just for the week. We had tech, utilities, discretionary, with energy being down slightly. Where healthcare, that was the strongest area. Staples, another defensive area. Communication ended up doing good, but that's growth. And then the financials were up just for the 5 trading days. But you go back to the beginning of the year, utilities are still leading the pack that way with tech, communication, and then healthcare is just a little bit positive here because this has been more lately what's been happening with healthcare. And you'll see the chart. We're still underperforming the S&P, even though it's improving. But then the staples, they're underperforming. Discretionary, they had been doing better. Now they're not. Real estate, materials, energy, they're negative year to date here. So and this is for the week. And when you have Nvidia coming out with stellar earnings, still down almost 6% on the week, yeah, that's going to do it's going to take a toll on a lot of the main indexes. Microsoft down even more than that. Apple was down just a little bit. You had Oracle down over 10%. So a lot of these tech areas see a lot of red in here. And then now Google has been bucking the trend. It's been holding up fairly well. It was up over 8% with both versions of its stock, but Facebook was down. And then the financials, seeing some more red in here. Amazon was down, Tesla was down. That's hurting discretionary. But then healthcare, an awful lot of green, especially in the big boxes here. And so looking at the relative rotation graph, we're kind of seeing everything. Just nothing really is up in the green area right now, but we're seeing healthcare just coming on strong now, which again is defensive. Utilities have been improving, energy's been improving, real estate's been improving, staples have been improving. And then XLY, that's tech, XLC, that's communication, industrials, financials, materials. These are areas that have been showing some weakness over the last year. And then going back here, XLK, that's tech. What is XLY? that is discretionary. That's been getting hit a bit hard too. Okay, and then here's where it looks a little bit different with tech, more neutral. We have some of the negative areas, and then the blue areas have been showing some improvement. And then looking at the indexes, we still see the OEX. That's the S&P 100, which has been improving. The S&P 500 still looking okay, even though it's been getting hit lately. The NASDAQ 100 is more yellow and starting to turn over to the left. We want these to go up and to the right. And then utilities doing okay. The Dow Jones Composite, transports, they have little pockets here and there. Where the mid caps, that's still one of the worst performing indexes. And then small caps are still just kind of figuring out what they're going to do. They have a couple of good days here and there, and then they give a lot of that back or go sideways. So we're still looking okay here with the S&P 500 and 100, where the NASDAQ 100 is more neutral. We're still seeing more weakness with the small caps and mid caps, and improvement with the Dow Jones Composite, utilities, and transports. All right, sentiment. This is interesting. After Thursday, we were at 6. Okay. When we get under 25, that's when we're like, okay, maybe this is overblown. And it fell all the way down to 6. And then with the bounce that we saw on Friday, we got back up to an 11. Okay. So, I mean, and you can see here, this is the context of this, where it's like, my goodness, we've really been going down. And this is probably to the market's benefit longer term if folks are so pessimistic right now, because usually we see the really, really big declines when sentiment is like way up here above 75. And people are saying, oh, it's never going to go down. This market's just going to keep going and going and going to the moon and beyond. That's when you need to really worry. When we've already seen negative sentiment along the way, it's like, okay, there's a lot of folks that are already nervous about the market, and that could help limit some of the declines if we see any more going forward. Also pulling back a little bit under this 90 level with the active asset managers coming in at 86.56 with that same survey. And we're above 20. And this is when we tend to see negative annualized returns with the VIX. And we've been going up. Now we came down a little bit on Friday. We were up at 26 in that range after Thursday. We're down into the 23 range now. So we're a little bit off of the highs, but still above 20, which is negative. And we're coming above the moving average when we look at cash versus the tech sector. We want this black line to be going down to be more positive. And folks are kind of freaking out between the bear and bull ratio here. When this goes up, they're more bearish. And this will probably spike because this is Thursday. And then a lot of people reacted to what happened on Thursday. And they probably got more into the bearish fund since we had a down day. And then we had an up day on Friday. So now they'll jump more into the bullish fund because they tend to do what's already happened. All right. And this wasn't updated, apparently, from stockcharts.com, but still looking overall net bearish overall with individual investors. Now, in the daily chart, we're above the moving average. Here on the weekly chart, we continue to be below it. I'm not really seeing any concern when we look at the spread between risky and not as risky bonds. And this is that inverted version. Now, if this continues to drop, yeah, we're going to get a lot more concerned. This is what happened back last spring. Now we're coming down. There's a little bit more risk than what we've been seeing lately, but it really hasn't shown a lot of conviction with fear increasing in the bond market. And we are going back up with the VIX and the 3-month average of the VIX. When we were coming down, that's when the S&P was going up. And now that we've been under pressure lately, this red line is starting to go back up here. And we're going down in the bigger picture here with the equity put call ratio, but you can see down here, we're just barely starting to turn up. It's picking up a bit of this negativity that we've been going through. Then some of these charts have been updated, some are not. This was updated, but we're not really seeing much of a change with the weekly economic index. And the Chicago National Financial Conditions still under the black line. That's positive. And coming in above 4% now with GDP now. Yeah, that's pretty healthy. Now, this tends to be pretty liberal. More realistic would be what the consensus is here, about 3.5% to the upside and just a little under 2% to the downside with the different forecasts. But this is positive for economic growth, and we're still looking pretty good here with the GDP now going forward. And even not seeing as much of a positive reading here with the New York Fed staff projection of what GDP will be, but it's still positive overall. And then this was updated. So we saw a little bit of a bump up here, but we're still below the red line. This is the real-time SOM rule recession indicator. We get concerned if it goes above the red line. And man, when we did back in late 2024, the perma bears were just partying hard because this is the perfect indicator. It's never been wrong that anytime we get above this red line, we're gonna go into a recession. Well, I follow the SON rule, SOM. I follow it's a lady, and I follow her on X or Twitter, and she kept posting things like, I don't know. I mean, I know my indicator is giving a high reading right here, but based on other research that I've been doing, I don't know if we can really trust it this time. And so far, she's been right, and the perma bears were just throwing fear out there like they always do. But this did tick up a little bit, but we're not seeing any real fear right now. Now, this was not updated. We're getting close up here to the black line. And this was not updated. This is a quarterly report, the Brave Butters Kelly Leading Index. We're still right around the black line here. All right, and not much of a change with our inflation now casting because we didn't get CPI this time, PPI, core PCE. We didn't get any of that stuff, at least yet. Now, this was what all the hubbub is about here. And now this is as of the close on Friday. There's a 71% chance now that they're going to cut rates 25 basis points when the Fed meets. I was saying December 19th, but it looks like it's December 10th. So I was incorrect if you heard me say that in other videos. But now the market's leaning more towards that, and that's where we got a bit of a bounce on Friday. But you can see how this has changed. So the blue, that's right now. And then we have a week ago, and then a month ago, where this is when it was like, it's a done deal. And then Chair Powell came on and rained on that, dropped down to here, and now it's been starting to pick up a little bit. And then you saw where they were pretty much, no, we're not going to have rates at the same rate. And then we immediately bumped up to that. And now that's starting to come down as the probability of a rate cut's going up. And then we look out at the next meeting, which is January 28th, there's a 58% chance that we'll be even 25 basis points lower at that meeting, which would be possibly not a rate cut in January because we're at 3.75 to 4. This would be 3.5 to 3.75. So again, I don't pay as much attention to this until it becomes the front month for the next meeting and kind of locking this in a little bit more here, a little bit of doubt, both with a greater rate cut or keeping rates the same. And then the Fed balance sheet, I just like looking at this once a week and it's continuing to go down. There was a guy, I think it was a guy, that posted something on X and he said, this is the holy grail. And he came up with this, I show it later on, this overnight lending that banks do. And he thought he uncovered something really big. Well, there's only one problem. You might uncover something big, but if the market doesn't pay attention to it, it's like it doesn't count. And we are still seeing a general upward move here of the Fed balance sheet. This is what I'm talking about here. He's like, oh no, I found something. I uncovered it. We're just 50% decline, man. And of course, there he gets all kinds of views and people make comments and all that. But okay, well, I read it, I'm aware of it, and we'll just keep watching this. That's why we look at this chart. Okay, now getting into our charts. Seeing a bit of a drawdown here with the advanced decline line based on price and volume, but still above the longer term moving averages and still below the moving averages when we look at the new highs, new lows. A bit of an expansion of the new highs, bit of a contraction of the new lows. So we're trying to improve here with the 4-week chart. We were improving with the 10-week chart, but this past week we ended up declining. We're still above zero with the advanced decline ratio, both short and intermediate term. And then this is the change. We can see the red lines going above the green line. We're still below 20. We're still below the moving average here. So it's still a weakening trend. But instead of defaulting to positive on the weekly chart, now we're defaulting over to negative. But we're still looking good here with the Arun. We're getting a very high reading above zero. It's come down a bit here, but it's still positive. No signal being given by the mass index right now. And then here, it's kind of hard to read this because now we have the pivot points coming into play for December. But yeah, so you can't really see all this. But we're below the 50-day moving average, and this is a daily chart. And so we've been above average for most of the days this past week. And then longer term, this is a 50-week moving average. We're still looking pretty solid here, even though we've been pulling back. And we're dropping a little bit below the 13-week moving average, but we're still in a solid uptrend with the moving average crossover. And then we were down 1.95%. We're still above this R1 pivot point here. Now, one thing I pointed out in the daily video, because I show this pretty much every day, we had been seeing higher highs and higher lows. That appears to be in jeopardy now. We've kind of broken this pattern of what we've been seeing lately. So we'll just want to watch for that. And we're coming down a little bit from this trend channel. We actually went above it. Now we're starting to come back down from it. Now, our smart money indicators, we're still positive here. We're negative on all three, with all three charts on the daily side. We're actually below the moving average on the daily chart, but we're still above it here, even though it's been coming down. Now, shorter term, this is turning a little bit more negative. We're dropping below the moving average with the boom indicator and declining. And we're seeing that same thing on the daily side, but we're already down here to an extreme negative reading with that chart on the daily side. And the chicken money flow continues to decline, and the chicken oscillator is also declining. So we're seeing some confirmation there on the daily side and here on the weekly side of negative readings. And even though we're coming down, we're still positive with the vortex, where we went negative with the vortex this past week. And we're still below zero here with the McClellan oscillator, and we're declining below the midpoint here. So this is some of the weakness that's coming in now with the summation index based on price. That's declining below zero, and we're also below zero and declining based on volume. Swelling trading oscillator. We actually turned positive after Friday on the daily side, but here the weekly chart, we're declining below the midpoint based on price and volume. And we're rolling over a bit with the PMO. This is a momentum oscillator here. This has been positive for quite some time, but you can see we're dropping below the midpoint and the moving average based on price and volume. But even though we improved a little bit here with the PMOs that are rising, the buy signals are still below 50 and declining, and we're declining with the PMOs that are above zero. And then on the daily side, after Thursday, we actually hit the lower Bollinger Band. We're still just a little bit above the midpoint here with the weekly chart. That's leaning a little bit more positive, even though there's some weakness. And now we're finally starting to see the two short-term oscillators line up with each other. The slope has been declining for quite some time, but the TSI was still going up. Now they're both starting to roll over. We're also rolling over with the three intermediate term oscillators. We're still positive, but starting to roll over here with the two longer term oscillators. And we're negative with the weekly Copic curve oscillator as well. Below 50 and declining, we're seeing that same thing over on the daily side. This is more negative. When we drop below 50, that means there's more point and figure sell signals that are being generated inside of the S&P than there are buy signals. And we're dropping below zero for the first time since last April with the force index. We'd been in the green, chopping around though, but now it's finally starting to turn red. This is a little more weakness coming back in. And with the down week, the week over week, we continue to decline there. And we're also declining after spending a lot of time up at this red line with the 50-week rate of change. We're already looking extreme. Now, this is showing longer term negative momentum with the Stochk RSI, and we're dropping below the midpoint, but we're not extreme with the Williams percent R, and we're declining but still above 50 with the money flow. The RSI, which is negative over on the daily side, both in the short and intermediate term, it's still above 50 here, but the context is that this has been declining with the 14-week RSI. We're falling below the midpoint with the ultimate oscillator. Now we're doing okay here with the weekly special K chart. We're also still positive on the daily side, but it's rolling over a little bit, and I'll show that in other videos. So longer term, this is still positive. Now, if we did set some kind of a high here, we'll be coming down. We fell below this 10-week moving average. Are we going to go all the way down to the 40-week moving average, which would equate to a 200-day moving average? And then if we fall even below that, then we have some fib retracement levels that we'll be watching. But we'll have to see if it even comes to that. And looking more negative here with the Heiken Ashi, and we're red now with the Kegi chart, but we're still positive with the Renko chart, and we're starting to turn more negative with the three-line break chart. And a lot of O's drawn in here. We have a double bottom breakdown here, and that is more negative for right now with the point and figure chart. And we're coming down. Now, we've been below zero now for quite some time with the ease of movement on the daily side. We're starting to go negative here on the weekly side. A little bit more weakness starting to come in now. Long-term momentum starting to come down a little bit. Intermediate term is declining. We're below zero and looking more negative with the short-term momentum. And then we've gone from neutral now to negative with the Elder's Impulse system. And here, the next one, this is a big one. Finally, after many, many, many weeks of the parabolic SAR being positive, we turned negative. The dot is now on top. And so that's another thing that developed this past week. Then broader market, this is all based on daily stuff here. The short term, I have us negative in the intermediate term. They use medium here. That's what MT is. I use intermediate term. And the mid caps have just not been really all that strong here. And then looking at the other markets, the commodities are now negative in the short term. The dollar's above 100 with the US dollar index, and we're actually in an uptrend on the weekly chart that I'll show in a moment. And coming down off of recent all-time highs here with the S&P, rolling over a bit with the mid caps and seeing a little bit more weakness, but closing up well off of the lows with the small caps. And then the Dow just set a new all-time high just not too long ago. Now it's starting to fight with its 13-week moving average, but it's still in an uptrend. NASDAQ, you're going to see a lot of the same thing, below its 13-week moving average, but still in an uptrend here. Also below the moving average with the NASDAQ 100. This is another NASDAQ 100 weekly chart, and you can see three red candles here. And so that's kind of ruining this basically positive pattern that we have been seeing. This is what we're seeing as far as the weakness right now. Mid caps still hanging out around the 50-week moving average. Not really looking all that good there. But we bounced up off of that, and we bounced up off of this too with the small caps as well. The NYSE also below its 13-week moving average. All stocks rolling down, coming a little bit below its 13-week moving average. This is US and international stocks. ARC fell down below its 13-week moving average, but also still in an uptrend. The FANG index, these are the really big stocks, also under its 13-week moving average. And then this is all the positive seasonality that just refuses to happen right now. That have been up 60% of the time going back to 2021 with a return of 3.1%. Well, it hasn't happened so far, and we're kind of starting to run out of November. All right, and then the banks just kind of chopping along sideways. We are still above 50 with the RSI, but the momentum down on the bottom is more negative. And then the Dow pulling back. Now, this is still looking okay here with the higher highs and higher lows for the most part. Not great, but looking a little bit better here. Where the transports just kind of do sideways. And now, lately, we've been doing a lot of sideways action with the utilities. And then we're still going sideways and breaking down below the moving average with the CRB index, which is the commodities. And we are dropping down into the 57 range with oil. Copper, this is still doing okay though. We're still in an uptrend here. This is the weekly chart. Silver, not back to new all-time highs, but still looking pretty strong. And then gold, just kind of chopping along sideways recently. There's the weekly chart of the dollar. See the golden cross here? We have yet to see that on the daily side, which goes completely against what you would think would happen. You would think the daily chart would change over positive first and then the weekly chart. Well, these moving averages were not all that far apart from each other, so they crossed quicker. And if this continues to go up, we could see more pressure on stocks like a weaker dollar. And then small caps, even though they bounced up a little bit, in the bigger picture, they're really underperforming the tech sector on the weekly chart. I've been watching this a lot too. We're down below that 100% level now with the weekly chart of the Dow Jones Semiconductor Index. We were over 100% above the 200-day moving average. Well, now that's starting to pull back. And the reason I've been honing in on this, the semiconductors back in late 2022 and into early 2023, that's what brought us up out of the lows. And now they've been pretty toppy here. They were very toppy in 24 and starting to get toppy again in 25. Well, when you get above this 100% level, this is where we often see more significant pullbacks after that. And so we're just going to continue to watch this. And this is the SMH semiconductor ETF. It never got up to this 100% level, but it was close and it's been declining as well. Then it's still doing okay here with bonds based on price with the total bond ETF. rolling over a bit, but still above the moving average with the monthly stock to bond ratio. Here's a daily chart where we were starting to go back up with yields, and now they've been dropping down recently. Here's a weekly chart. We're just continuing to go up here with the Japanese 10-year yield. The freak out that we had in August of 2024, that doesn't seem to matter right now. That's the carry trade and not John Kerry. It's carry like you carry it from one place to another. And then we're still seeing some hits here, but looking okay. The S&P 100 to 500, that's still doing okay there. And we still have gold as the best performing asset with stocks in second place. You've got commodities and bonds based on price about neck and neck. And we have the dollar and oil negative year to date. And here, pulling back here with the NASDAQ 100 to S&P ratio, but still in the bigger picture positive. Growth to value pulling back, but still positive in the bigger picture. And we're going back up here as gold has been going up, stocks have been going down. So we're seeing this ratio going back up lately and kind of plateauing a little bit recently with the gold to dollar ratio. And then coming back up, going a little bit above the moving average with the bond to stock ratio, but not enough to change the longer term trend. Stocks are still outperforming. Discretionary pulling back here, but still outperforming staples with the weekly ratio. And this is the low volatility. Now, bouncing back up here as the market's been getting more defensive. Bigger picture, though, this ratio has been going down, which is positive for the market. And then energy, it has its moments here when we compare it to tech. But in the bigger picture, energy continues to underperform the tech sector. Then longer term here, now the NYC Brent thrust, not really much of a change here. What's interesting is after Thursday, there's a 1 day lag. We potentially are having a setup for another ZWAG NYC Brent thrust, which could end up being positive for the market. After Thursday, we had an extreme reading below this level. Now, if we stop going down at the point we do go down, because this could still go down more than where it's at, probably not after Friday because we had an up day. But if this, whenever this stops going down, that we make note of the date. Right now it's November 20th, which was Thursday. And then we have 10 trading days, which would be December 5th right now. We have to go from this blue line all the way up to this red line, and that would be a ZWAG NYC Brent thrust. And that's very positive for the market. Here's some previous ones. We had these Brent thrusts here, and then look at what the market did after that. Now, we had one back in October here, we had the initial dip down. That was a big down day, but we never got back up to the red line to have a valid signal. And then, but this is where we came up out of this in the April lows, and then we just have been going higher here. So if this does develop into something, and right now we don't know if it's going to or not, we just have until Friday, December 5th, based on if this is the low, if we can get up to this red line, that could end up being quite positive for the market. It's just something that's on watch for right now. And then really didn't change. We're still at a -4 with the NYC Zahorchak method. And coming down here, this is longer term, a 50-day moving average of the new highs, new lows for the S&P. Still above zero, but this has been pulling back lately. Also coming down, but still above zero with the NYSE new highs, new lows, 50-day moving average. And dropping a little bit below this long-term trend line with the NASDAQ 100 weekly chart. But we're coming down a little bit, but the ratio is still looking really good with the NASDAQ 100 to Dow. And the NASDAQ 100 to small caps, that's still holding up quite well. And we're still tending to come down, but we're starting to plateau a bit here with the 3-month yield. And then still going up, but now rolling over just a little bit with the cumulative new highs, new lows for the NASDAQ. Then seasonality, yeah, this is what, we should be to the moon by now. But the first half of November, I should have changed the arrow over here. The first half wasn't all that great. We still have a big question mark with the second half of November. And then here, November, one of the better performing months all by itself. Tell that to 2025. And then whether you measure from June to November, that's pretty good. But the November to April period, that tends to be even better. And then this also shows that we should be positive. We are positive with seasonality. The market's just not cooperating. And this also shows how November is one of the strongest months of the year, if not the strongest. This also shows positive seasonality that hasn't been happening yet, positive seasonality that's not happening, positive seasonality that's not happening. And then here's the Hindenburg moment. We don't have any recent spikes. This is a daily chart. and it was updated as of Thursday. But we had the initial spike back on October 10th, and now we've had some additional spikes here. And so, yeah, we want to just pay attention to this because this is what we saw right before the COVID crash, and we also saw it at the end of 2021 before we went into the bear market of 2022. So it's just we don't base our decisions on this. We just say, okay, we see what's happening here, then we'll look at other charts and say, is that confirming things? Right now, in the short term, yeah, it's confirming that. In the bigger picture, no, it's not, because the bigger picture is still positive. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.